Crude oil prices are challenging a two-year downtrending resistance zone as nuclear negotiations between the US and Iran proceed today in Oman. This geopolitical backdrop is sustaining upside hedging flows and keeping bullish breakout risks on the table unless clear resolutions emerge. Hello everyone, this is Razan Hilal, market analyst with Forex.com. Today is February 6, 2026. Looking at the crude oil chart from a weekly time frame perspective, we can see that the price action has been respecting an uptrending bias since the lows of December 2025, tracing consecutive higher lows and higher highs within the bounds of an uptrending and parallel channel. Now, this price action is currently challenging a very critical resistance near the 66.80 mark, or rounding it up to the 67 mark, which aligns with the upper bound of a downtrending channel respected on the chart since September 2023. Now, a clean hold above this level is expected to extend gains in line with the heightened geopolitical tensions and supply disruption risks across the Middle East and also between Russia and Ukraine as well, uh, possibly extending gains all the way towards the 70 mark initially, which was the previous high of July 2025, and further towards the peak that we saw in June 2025, also in line with heightened Middle East tensions, all the way towards the 78 mark that can define either a long-term bullish breakout, sustainable bullish breakout for crude oil prices back towards 90 and the 100 barrier, or another potential pullback to at least retest the upper bound of that respected downtrending channel. Now, from the downside, should price action reverse back below that critical support zone over here, where we had a sharp weekly rebound from, which is near the 61.30 mark, a clean hold below this level is expected to extend losses possibly back down to the previous respected support level near the 60.40 mark before possibly exposing another drawdown towards the mid zone of that respected downtrending channel, possibly aligning with the 57.70 mark first and the 55 zone next, which is the support level respected on the chart all the way since the lows of April 2025 that can open the way towards either another bullish rebound or a deeper drawdown towards the lower bound of that respected downtrending channel for potential long-term dip buying opportunities. Now, looking at the Brent chart, also from a weekly time frame perspective, we can see the price action is also aligned within an uptrending bias and uptrending parallel channel, connecting consecutive higher lows and higher highs since the lows of December 2025, which managed to have a brief penetration to the upper bound of a respected downtrending channel since December 2023 on the charts, and recently pulling back within the bounds of this channel, which is reflecting uncertainty with respect to this breakout. Now, the overall bias is still pointing to the upside as long as price action holds above the 65 mark. A clean hold below the 65 mark is expected to shift the bias towards a bearish one, possibly extending losses down towards the 63.80, the 62, and all the way down towards the 59.80 zone, which is near the mid zone of that downtrending channel for potential dip buying opportunities. If not, then we might have a further bearish forecast extending all the way back down towards the 58 and further towards the 51 zone, which is the lower bound of that respected downtrending channel, a scenario similar to the WTI chart. Now, from the upside, since we have persistent, or since we have a bullish hold in line with rising tensions in the Middle East, a clean hold back above the 71 mark is expected to extend gains all the way back towards the 74.60 and further towards the highs seen in June 2025, which are near also the 78 mark. That can also either define a long-term structural bullish breakout for crude oil prices or another pullback, also at least to these previously defined resistance zone and the upper bound of that respected channel. In line with the previously defined key breakout levels, upside risks across crude oil prices and commodities warrant caution as prices remain sensitive to the overall nuclear negotiations between the US and Iran that can have an overall impact on regional stability and market sentiment.